A lot of investors feel like if they pick the right stocks and hold them for a long time, that they will get wealthy. They will have financial independence, which is really, I think, the goal that we all want from our investing. This channel is really for proactive investors. It's about optimizing investment savings. It's about strategies other than long-term buy and hold investing in stocks and bonds for decades, because historical data clearly shows that this doesn't always work in some decades, even though it's worked brilliantly in others. And also about creating income streams, because the more income sources we have in retirement, the less savings we need for retirement withdrawals. All right, so hi, by the way, I'm Camille Gaines, and here and my website, retirecertain.com, I share this information. All right, so let me start with the pros of long-term investing in stocks. First of all, it's easy when compared to an investment like real estate or small business. I get that. And even though I'm an advocate of, for most people, having some sort of alternative investment outside of just paper assets like stocks and bonds, I get that a lot of people have enough wealth that all they need to do is own stocks, and that will work fine for them. And that is a big advantage of stocks, in that they're very, very simple to own. The next advantage or pro of long-term investing in stocks is that passively it can build wealth over very long periods of time, very, very passively, particularly, and I could almost say exclusively, during favorable stock market conditions, which usually the stock market is going up if we look at really, really, really long-term cycles. Okay, so that's the pro. Number two is passive increase of wealth. Easy passive increase of wealth, especially if index funds are owned. The next pro of long-term investing in stocks is that long-term capital gains have low tax rates. This is a fantastic advantage that allows investors more money to compound over time, and compounding builds wealth passively. The next pro is that long-term investing in stocks can be done for a very low cost if desired. Now, a lot of people want to pay a financial advisor, and that's fine for long-term investing. Everyone has to do what works for them. I like to tell my clients there is absolutely no cookie cutter formula or way things should be done. You have to do what works for you. So long-term investing can be done at a very, very low cost if this is what you choose. This low cost also results in more wealth compounding, just like the lower taxes, because there's more money there to compound. The next pro of long-term stock investing is it's easy to reinvest. Therefore, investors tend to reinvest dividends, thereby leading them to accumulate more wealth, simply because they're not only experiencing capital gains from their stocks increasing in price most of the time, but they're reinvesting the company earnings that are paid out as dividends back into company stocks. And that leads to even more compounding. You're hearing the word compounding a lot in this, because these are pros of long-term stock investing. Don't think there aren't cons, there are. So stay tuned. All right, and finally, investing long-term, it's easy. So investors tend to actually do it versus leaving money in cash or in money market. Some of my clients come to me with all their money in money market, or most of their money in money market, because they're afraid to invest in stocks. Stock investing is easy, or I should say, because it seems complicated. Stock investing is not really that complicated. So this is something that attracts investors and leads them to take action and actually do it. Now, having said all these wonderful things about long-term investing in stocks, I tend to no longer at this point in time be a long-term investor in stocks for various reasons that I won't go into in this particular video, but I will lead into the cons, and that will actually sort of tell you why I'm not a long-term investor in stocks right now. Okay. So the first con I want to share is that the time frame during which an investor has bought and held stocks determines if the desired or needed investment returns will be met while the stocks are owned, period. It's the time frame that determines the success. There's this assumption, again, that investing in long-term stocks will build wealth, but the time frame will determine whether or not this is true. And investors are taught if they just buy stocks and hold them long-term, they'll increase in price, they'll go up in price. That's not always the case, but we hear it over and over. Invest for the long term. It depends on when the stocks are bought and the stocks are sold, the time frame in which the stocks are held. And this leads into other cons here. Stocks perform well during some economic periods, but not others. And there are economic cycles. There are economic periods, period. So this means that stocks don't always perform well. All right, so the next con is that factors way outside our control affect whether a stock or a stock portfolio long-term will increase in price. That can include everything from company management to stock market cycles, even global macro events, black swans, regulatory changes that happen, politics. There's so many different things that can determine or affect whether or not a stock or a portfolio of stocks or stock index performs well over time. Most stock investors overlook other assets, and this is the next con, that perform well during certain economic periods. Things like real estate, gold, and other commodities. So one of the problems with stock market investing is I see often, usually, investors are all in. It's all stocks or it's cash, maybe some bonds, but usually now the clients that come to me have all stocks and or cash. And other assets that do well get overlooked because investors think only in terms of stocks. So that's one of the cons that I see as far as long-term investing in stocks. Another con is that investors assume, and I've touched on this one already, stocks will provide financial independence. But if we think about it, most wealthy people got wealthy from business or real estate, not from stock investing. Maybe someone got wealthy from a big bonus in their employment. That happens sometimes. Some people get wealthy from inheritance, but not necessarily stock investing unless it's really slow and methodical over very long periods of time in very favorable market environments. If we look at Warren Buffett, he really got wealthy from buying huge positions in undervalued businesses and helping them increase profits. I like to think of Warren Buffett as more like an entrepreneur. Dave Ramsey got wealthy from small business, starting with his debt reduction programs, which were initially launched to church groups. So a lot of people feel like they will get wealthy from stocks and that everybody gets wealthy from stocks, that's how wealth is built, but that simply is not the case necessarily. This leads me to the next con, and that is that because long-term stock investing is long-term in nature, many investors feel like they don't need to frequently evaluate or reassess either the individual stocks they own or the indices or whatever their stock ownership is. And this can be problematic. We need to evaluate, if we have individual stocks, we need to evaluate them ongoing, stay on top of what's happening at the companies so we can make sure that they continue to be good investments. If we own stock indices, then we need to make sure it still makes sense to own stock indices because sometimes stock indexes become very overvalued. Really, your age and your financial goals will determine if long-term stock investing is suitable for you to even consider. Then the next level to consider is where stocks are in relation to historical cycles. This is a factor that many investors overlook. Remember, retire certain with enough money to fund your desired lifestyle.